Hello, friends. So, welcome to this very special episode on gold. And you would have often heard me say, buy gold, get gold into your portfolio. But this title is just saying, mat kharido gold. So, why am I saying that? Please watch the entire video till the last slide and then decide. Let's dive in. So, with gold, as you would have already, come to know, there are two major advantages. One, of course, it is a hedge for inflation. So anytime you look at long-term charts, you will find that gold has met or done better than inflation in almost most currencies. Uh, and then if one were to compare it with uh, local indices, then within India, you could have seen that, let's say in year 2000, when Nifty dropped 46.19%, gold was up about 19% in the same time period. In 2008, when Nifty dropped 56%, gold was up 41%. And gold in INR terms here, uh, for a comparison, as a hedge against not only inflation, hedge against equity markets not doing well, hedge against your currency not doing well, hedge against some, joker government coming into the parliament, hedge against a lot of nonsense. So a solid hedge uh, against something, which is not the usual business as usual flow. Any disruption of any kind, geopolitical, currency, um, political, government, uh, equity markets, interest rates, this is a hedge for everything. 2008 crisis, 41% up versus Nifty of 56% down. 2011, 35% up when Nifty was down 26%. And recently in COVID, 32% down Nifty, gold was up 31%. Perfect hedge, in fact, better than perfect hedge when it comes to, against your equity portfolio. And besides the hedge, so this is the dual sort of dual engine starting on, is that it also beats the performance of many portfolios. So 11.9% has been the CAGR in rupee terms. So not only is it hedging you against this, not only is it beating inflation, not only is it protecting you from everything, but it is also giving you fantastic returns. Let's dive into some history on this performance of gold in major currencies. So let this be a master class in gold in US dollar terms. So this is the gold chart for US dollar gold. You can see you had a fantastic move from 1971 when President Nixon closed the gold window. What was that? Closing the gold window meaning that till 1971 US dollar were, uh, you could replace your US dollar with gold at certain price. So it was exchangeable for gold, and any central bank could ask US dollar that, okay, we are giving you back your dollars, please give us the gold in return. So there was an interoperability of gold at a certain price. And in 1971, uh, 15th of August, President Nixon said that we are temporarily shutting off this facility of exchange of gold versus dollar. And gold just leapt up like nobody's business. Gold went from $35, which was the controlled price, to nearly $800 within a matter of few years, 7 or 8 years. Gold went up almost 22 or 23 times, something like that, in this period. Then, of course, there was a huge consolidation for next couple of decades as central bankers made use of this repricing of gold, and they sold off many countries like UK, Canada. They sold off their gold, and there was a supply pressure in the market. And then 2001 onwards, a renewal of the uptrend was achieved in gold, and we have been ever since going up. 2300 odd is the current gold price. So this is the US dollar gold price, and this is of course the US dollar S&P 500 equity chart of the last 5 decades. Seeing these two charts, would you imagine the next chart? I would think not. So we've taken gold in this current century from year 2000 onwards. Gold in US dollar terms from year 2000 in the last 24 years is up 721% in dollar terms. S&P 500 in the same time period is up 290%. You may say that if I selected some other date, then the performance could have been different. Yes, it is possible, but 24 years is not a small period to evaluate over. And at no point of time am I making the contention that gold does better than equity. Gold is a compatriot of equity. Gold is like insurance for your equity portfolio. But at many times, gold also give you fantastic performance. So you get like best of both worlds. You will also protect your major investment as well as get performance in the insurance. So 721% versus 290%. If any USD holder had bought gold versus S&P 500, they would be sitting pretty as of right now. Let's see in Europe what happened. Gold in USD Euro CAGR since 2000 was 8.6%. In, let's say, Euro stocks, the ETF or the index, since 2000 we haven't really gone anywhere in terms of equity. So if you compare the two, the equity has done nothing, whereas in Euro terms, gold is up 650%. So any allocation to gold, 25%, 30%, 40%, 50% would have done wonders to both a US portfolio, also to Euro portfolio. Great Britain pound. What were the Britishers doing? Once the rally started, CAGR since 2000, 10% only. And since 2000, the FTSE 100 has really not done too much since then. Last 24 years, gold in Great Britain pound 931% up versus 19% of FTSE index. That is the kind of, I mean, it's not even a hedge actually. I mean, there is no comparison between the two. Let's take Australia. Australian dollar since 2000, 8.9% returns CAGR. Australian ASX 200 since year 2000 is also done well, no doubt in there. But comparatively, the equity is up 148% in 24 years. In Australian dollar terms, you are up 692%. Canadian dollar has been going up. Gold 8.7% CAGR. Canadian TSX index also has done well since year 2000, no doubt about that. In comparison, gold is up 642% in Canadian dollars, and the equity is up 190%. In Chinese yuan, 8.3% since year 2000. Chinese markets since 2000 up till 2007 and then flat. These SSE composite index, when you put them together, you have the Chinese yuan based gold up 621% and the Chinese equity market up by 100% in 24 years, 93%. Japanese yen, 10.9% in Japanese yen gold performance for the locals. For Nikkei index since year 2000 also market has gone up, although on a very long term basis market has gone nowhere. Overall performance 1120% in Japanese yen terms on gold, 99% on Nikkei 225. Last but not the least, gold in INR terms. This is the performance, 11.9% since year 2000. Just let it sink in, 11.9% for a hedging instrument, for an insurance instrument. Equity should be giving you 20% if a hedge can give you this much. Nifty also, of course, has done well since the last 20-25 years. Remarkably, since year 2000, gold in INR terms and Nifty have delivered the same results. Isn't that remarkable? And just look at periods when Nifty did not do well, the one that I showed you in the first slide. Nifty dropping, gold going up, Nifty dropping, gold going up, Nifty crashing, gold going up. Every time Nifty will crash, gold will go up. So a perfect hedge is available in gold for you to have. So essentially beating inflation, hedging your equity portfolio, hedging your all other assets in INR, whether it is your house, whether it is your any other investment, your debt investments in India, your bet on the country, your bet on the politics, your bet on the currency, everything is hedged by gold, and you also beat inflation. So if you don't agree with all this, mat kharido gold. But this is the last sort of straw on the camel's back, that if you cannot get convinced after seeing these cross country, across the world situation of what gold has done, definitely don't buy gold. But the other ones, the other guys know what to do. Thanks. Bye.